Welcome to the Retire with Peace podcast, the podcast where we help you create a fulfilling and stress-free retirement. Each week, we bring you expert advice, practical tips, and inspiring stories to help you plan and live your best retirement life. Whether you're nearing retirement or already enjoying your golden years, this podcast is here to support you every step of the way. Let's embark on this journey together and discover how to retire with peace.
Welcome back to the Retire with Peace podcast. As always, I'm your host, Dave Zegel, and today's a review day. We did episodes, it might have been episodes 1 and 2, very early on in this podcast, talking about traditional and Roth IRAs. A lot of times we'll talk about some slightly more complex topics in terms of tax strategies and investment structure strategies and all these different planning strategies. But then inevitably, I get questions on, okay, I still don't know the difference. What are these two IRAs? You talk about traditional, you talk about Roth, you talk about converting them, and we're not going to talk about conversions today. But what are the differences between the traditional and the Roth IRA? I still get this question, and it's fine. It can be very confusing. There's lots of rules. There's even other types of IRAs available to you if you're business owners. But for today, let's just cover traditional versus Roth IRA. First thing to note is that there are income limits for being able to use these two. So a Roth IRA has its own income limit, so on your tax return, and that income limit changes, and it's different for single versus married, so I'm not going to cover all the exact dollar amounts as it stands right now. But just understand that there are income limits to being able to put money directly into a Roth IRA. There's not an income limit for a traditional IRA for making the contribution. However, there is an income limit in order for you to get the tax deduction for using a traditional IRA. So what's the difference between the two? Now that we have that general backdrop of, yes, there are some limitations in terms of income, in terms of how you're able to use them, what's the difference between the two? The traditional IRA provides you a tax deduction for putting the money in, as long as you're under the income limits, like I just mentioned. It gives you a tax deduction for putting the money in, but then when you take the money out in retirement, you are taxed on whatever money is coming out, and that's taxed at ordinary income rates. The Roth IRA works completely the opposite. There is no tax deduction for putting money into the Roth IRA. However, when you take the money out, it comes out completely tax-free. Therefore, which one you choose depends on what your tax plan needs. Do you need the tax deduction now and you're willing to pay the tax later, even not knowing what the rates might be later? Or do you want to use the Roth instead, where you don't take the tax deduction now, but you get to enjoy tax-free benefits in retirement when you take the money out? There's not necessarily a right or wrong answer between the two. It has to do with what your tax rate is now versus what we think the tax rate might be when you retire. And that's a tough guess. It really is. Depending on how far out you are for retirement, that guess can be even more difficult. But suffice it to say that if you are in lower tax brackets right now, you will generally benefit from the Roth IRA versus the traditional IRA. Because you're paying low tax rates now, the chances are that tax rates will be either the same or higher when you retire if you're paying low tax rates right now. Versus if you're in the higher tax brackets, it probably makes more sense to put money in traditional IRA, because perhaps when you retire, your income tax rate might be lower. Now, there's a lot that we can debate with that. And I know different people will say different things. Some will say, hey, just don't worry about the traditional, just pay your tax now and enjoy it tax-free later, regardless of what tax rates will be. I don't have a great argument against that, other than to say, maybe that's true, maybe it won't be. We just don't know. So we can't predict the future. We don't know exactly what tax rates will be. So the best course of action, in my opinion, is to have a little bit of both. That way, when you get to retirement, you will have two different types of accounts available to you, and you have some control over picking and choosing which one you take from, and therefore you have a little bit more control over your tax plan when you are actually in retirement. Let's say, for example, you're working in a company and they have a 401k. I know this deviates a little bit from the IRAs. We'll get back to that in a second, because the IRAs are separate from your company plan, and you can have both. But let's say you're working at a company and they have a 401k plan. Well, typically, and this is changing a little bit, but typically you put money into it and the company matches it, and the company match is in the form of a traditional IRA. So the company is getting a tax deduction for making this contribution to your retirement plan. And therefore, since they're getting a tax deduction, it gets taxed when it comes out. So what you could do is you could contribute something that is in a Roth 401k if it's available to you, and the company will be considered contributing to a traditional IRA, and therefore you'd have both pieces. You could also do the same thing in a Roth. You could do a little bit of both if you wanted to. It's going to come down specific to your tax plan from a tax planning perspective, but I want you to understand the differences between the two. The traditional, you get the deduction now, but you're going to be hit with tax later. The Roth, there is no tax deduction now, but all tax-free later. So understand that they're two different vehicles. You can use both of them. In fact, right now you can contribute up to $7,000 per person per year, not to each, but in total, you can put $7,000 into an IRA account, or two IRA accounts in total, $7,000. If you're age 50 or older, you get an extra $1,000 that you're allowed, so you can get up to $8,000 per year. Again, there's income limits. There's lots of things to be considered, but for the purposes of what we're talking about here, just understand the differences between the tax treatment on the traditional IRA, where you get taxed later, but tax deduction now, and the Roth IRA, which is no deduction now, no tax later. There's no right or wrong answer, but it's important to understand the difference between those two.